everybody. My name is Stanley and welcome to my channel. Where once again, this is our third day of our live webinar. And today we're going to talk about something that quite embarrassing for me, which is my biggest investment mistake. I'm thinking of this topic because I feel that there might be some of you out there who might be holding on to some loss-making stocks and you're wondering, what can you do about it? Should you hold on to all these loss-making stocks, or how do you make a decision that if you should move on or stay on with it? So I share a little bit about some of my clear mistakes and what I learned from them, and hopefully give you some ideas of what you can do with your stock currently. If you can hear me clearly, give me a shout out on the live chat. I can see some of you already here. Tian Sang, Ming Li, hello. Adrian, wow, very fast with the question. Keep your question coming. If you have any question, just write it down on the live chat. I'll get to them as soon as I have a short presentation for you guys. And after the presentation, we'll go right on to the question and answer. Just on the question with Adrian, what do you mean by biases? Maybe you can explain a little bit. Is this kind of negative biases that we should try and control, or are these positive biases that we should lean into? Maybe you can explain a little bit about your question. Okay, hi Doris, hi Anson, nice to see you guys. So without further ado, let's get started. Alright, our simple disclaimer. Alright, these are just my personal view, so do your own research when you're investing. Okay, and also this week, we have a very special news, which is our VIA Club is open for registration. We tend to only open once in a while, every few months, when we have on board some of our old members and we are able to service them and know that we can take on more capacity. Then we open up the registration for VIA Club, and we are very happy that we are able to reopen it just for this week only, but more on that later. But today, the third segment of our live webinar. In the first segment, 2 days ago, we talked about how you can prepare your portfolio for the pandemic. And then we talk about the 5 key aspects that I'm looking at when investing right now. And also, yesterday we talked about 3 stocks that I'm holding for the long term and I'm very optimistic about. If you missed both 2, you can check it out on our YouTube channel and you can view the replay. But today I'm going to talk about the opposite side of that coin, which is my 3 biggest mistake and what I learned from it. And if you can see this slide, this is my major mistake in the past, which is investing into Blackberry. If you know about Blackberry, they are sort of the smartphone of choice before Apple iPhone kind of came about. So the pre-2007 era, the main smartphone of choice is Blackberry. And as Apple and Android started gaining market share in the phone segment, I thought that Blackberry could be an interesting turnaround company. That is because they acknowledge that they are facing some slowdown, and they make big changes, such as changing the CEO, which is a very high-profile CEO coming in, very optimistic, very charismatic, and very confident that he can turn around the company. And plus, they don't just have a smartphone business, they have a very profitable software business. Number one, which is their BBM subscriber base, which is still very profitable for them. And they also run some operating system software for things like power station, the huge government security system, and even for cars. So at the time, I thought, this could be an interesting turnaround company. But guess what? I bought it, if I remember correctly, I bought it around 2000, maybe 13 or 14. We're at around price of 7 to 10. So I bought it at multiple tranches. Was very volatile. The stock was very volatile, but as you can see, it never quite recovers. The business just slowly faded away. Even though the stock price can be volatile, and at times, if I'm good at market timing, I could came out profitable. But the whole experience showed me something that it's quite profound for me, and it kind of changed the way I invest. which is I sort of found out that turnaround companies sometimes they rarely turn around. that's very key. And why is that the case is because if the management or if the company has the ability to turn around, then they could have very well prevented the slide in the first place. They could have very well predicted or know the threat that is coming, that is disrupting their business, and could have turned away from the traditional business way before they see the slide. So if they're already sliding and they say and promise that they can turn around, most likely I'll take it with a pinch of salt right now. So it's more misses than hit for turnarounds, I feel, generally speaking. So that's kind of a sector that I try to avoid in my own portfolio at the moment. And I guess I can say that quite frankly, Blackberry might be the last turnaround company that I bought, and after that, I really shy away from any turnaround situation. Next company I want to talk about is a very, very small cap stock in Singapore on SGX, and it's S-Chip. So it's a China-based company that but listed on the Singapore Stock Exchange. Today, it is already delisted. If some of you might be investing back in 2012, 2013, you might have heard of this company called Areta Lifestyle. They started out as a sportswear company, saying that they are a sports apparel company, and then they changed and say that they are a menswear lifestyle company. Maybe that change should be a red flag, but at the time, I was a very what they call in the market a deep value investor. So I always hunt around for very cheap stock in the market. I hunt in the newspaper reading at the 52-week low segment and see which stock is at the lowest point right now, and I hunt in that ground. Look for low PE, good dividends, and so undoubtedly this company fell into my radar, my screen. And when I bought it, in valuation term, it is extremely, extremely cheap. I bought it at actually 1 times PE, right? So the price to earnings, I bought it at 1 times earning. So in theory, it's earning 100% every year for the shareholders. And plus, they are giving out quite a decent dividend at that time. So I thought, well, in that case, then this company might not be a fraud. Could be, if they're a fraud, they shouldn't have the ability to pay a dividend, but they're paying a dividend. Plus, their net cash is actually more than their market cap at that time. So everything ticked the boxes of a cheap stock. I bought it. And just within a few months, when the cash is still at all-time high, the company called for EGM, saying that, we need to raise a convertible bond. And the effective rate of that convertible bond is roughly around 20% interest rate, right? 20% interest rate. And I actually went to the EGM, and the CFO was making the case of why they need the convertible bond, saying that it makes so much sense. Right after I left the meeting, I knew this company was a fraud, and the cash wasn't there, and I sold off. So I didn't really lost money per se in this stock. I sort of break even, but it's a big lessons for me, because leaving that EGM, I felt like a fool. I've been duped by this company, and that really changed my investment style from a deep value investor just looking for cheap stock, and changed my whole perspective that instead of looking for cheap, we should be looking for quality. Because when everything seems to be too good to be true, why is it so cheap? Most of the time it's not true. And cheap rubbish is still rubbish, right? I try to stay away from very cheap stock right now. And that's the main reason, because in today's of age, unlike, yes, being a very value investor, it might work, say, during Buffett era. But during our current times, where information is quite easily accessible to everyone, it is highly unlikely that we can spot a stock that is so cheap that is not detected by the market already, that is not detected by other investors. Most likely, why it's left cheap is because other investors know something that we do not. right? So instead of assuming that I am smarter than everyone and I have found this wonderful stock that nobody found, I should actually be wary and ask myself, why is no one else interested in such a company? And so that's sort of turned my entire approach to investing. Now I always screen for high quality business first. When I do a screen, I never do a screen on the valuation at all. I only screen for their good margins, their growth, how is their ROE, to make sure that the company has good financials. And then from that, I create my own watch list and I monitor if I want to buy it at a much cheaper price. Then I monitor when is the better time for me to invest into these high quality companies instead of just looking for very, very cheap stock and hoping that I might not be fallen into a value trap. So that's lesson number 2 that I found, which is, I guess, one of the most painful lessons that I realized. And the last one is actually, I learned it from a company called GoPro. their tagline is be a hero, right? And I really tried to be a hero when I invested in this company. Because at that time, when I invested in it, GoPro was flying high. They are transforming the videography industry. People are starting to able to take video of live action at a much cheaper entry price. The market has joined the hype. The companies has a high flying stock price. Plus, the CEO at the time was also very flamboyant and outspoken and larger than life. Sort of like I guess Elon Musk. But and I'm a consumer of that stock. A consumer of this company as well. I like the product. So it ticks every box. I know the products is wonderful. It's high flying. And they are going through a transformation as well at the time when I invested from a camera company to, they say they want to become a media company. So wow, everything is exciting. They have all these things that they can become a live media company and a lifestyle brand, maybe sort of becoming like a Red Bull, more than just a drink, but just an entire lifestyle. That's fascinating. But the reality is, this is one of my biggest loss till date. I think I bought it, I can't remember, but when you look at the left hand side of this chart, I probably bought it around this time. I lost, I think, close to 95% of all my investment into this company because I got carried away and joined the hype. I tried to go into, I guess this is one of my first foray into growth investing, but there are different levels of growth investing, and I tried too hard and joined into a hype wagon. And what I learned from this lesson, both is a painful financial lesson for me, but also fundamentally, it changes my investment style again, that I should really stick to fundamentals instead of, falling into the hype and feeling that this company has a great story. Look at the financials. Is it really translating to the financials? Is the margin of this company good? They are in. Is the technology really that unique that nobody can copy? In today's, when you can see so many action camera coming out, the technology is not that unique. It is quite a simple technology that, as technology improve, many other companies are having similar type of cameras like GoPro, and they try to do drones and they are unable to compete in that sector as well. So whenever I see companies that say that they're trying to transform, it could be exciting. I try to shy away right now. I might miss out on some winners. Maybe you're talking about C Group in Singapore with their e-commerce play into Shopee doing very well, but still unprofitable. Or maybe even Razer. Also, Razer is a very similar company to this GoPro company because they are now in hardware and they're trying very hard to become sort of like a software company with Razer Pay and become a financial company. Or even Singtel, right? Singtel with they're trying hard to bid for the digital bank license and trying to be a financial player. All the story sounds great, and the transformation, if it's successful, sounds great. But if I really like the sector, say in fintech, then I can probably just invest in the leaders of fintech today, be it PayPal or even Visa or Master, because they tag on to that growth. Instead of putting my bet in a company that is not really in the business, but trying hard to become the next big thing in a new industry. Sometimes it works, right? Surely sometimes it works. But most of the time, if we're going to fall into the trap of trying to invest in such a strategy, then we have to be comfortable that many of our picks will be duds. And we could have many stocks that end up losing 90%. And then with one company that work. That could probably be, if you're comfortable with that strategy, that could still be a relatively reasonable strategy, but it just doesn't work for me, and I switch away from that kind of strategy. So yes, even though there's a lot of exciting companies with new development right now, even if I bought them, I'll buy them at a very, very, very small allocation rather than let them be some of my biggest position. So sizing, I learned about sizing a position is also very important, and I rather stick with the leaders of the field rather than some companies that will trying to become something that they are not. So these are the three main lessons that I learned from my huge mistakes over the past 14 years that I have been investing. And so today, if you look at my own personal portfolio, it kind of mostly focuses on high, strong, established and growing companies. If you look at a few of my top holdings, these are leaders of their fields, be it in consumer like Guizhou Maotai, or be it in tech like Tencent or Apple, or in e-commerce like Alibaba. So I try to focus on more of the more established and leaders of the field. Maybe they don't give the most amazing return, right? They don't return as fast as, say, a C Group or Pinduoduo, but they keep me resting at night. I don't wake up wondering how's the US market doing, and eagerly checking my portfolio every single day. I rarely check my portfolio. If not for our VIA club, I tend not to look at my portfolio. But for my VIA club, I actually track my performance of my portfolio since when we started VIA club for my members, and this is roughly what my portfolio have been doing. This year was quite interesting, and even during the slide in March, I saw about a 10% drop, and then it has rebounded since then for about 40%. So in a way, it kind of shows me that my portfolio is actually quite defensive in nature and make me even more comfortable with my own portfolio. So this is just one of the things that we actually share with our members in VIA Club. As I mentioned before I go into some of your questions, I can already see many questions coming up. I'm very eager to answer some of them. And I just want to let you guys know that the VIA Club registration is open for this week only until Sunday. And if you're interested, do check out on the link. It's bit.ly/club VIA. And I hope you can take a look at it and see if something that you are interested in. Just let me go through some of the features that you might get from VIA Club compared to what you get from our free website. Right? Every week I try to give a very detailed report for my VIA Club members, and sometimes it includes our stock of the month. So every month I will present one stock idea for our members, and we track the performance. And so far, these are actually some of the stocks that we talk about, and the returns has been pretty good since our feature of these stocks. On top of that, every year we actually publish a stock guide. We have been doing it for about 4 years now, and include a grand webinar where we spend as long as the members needs to explain to them the 10 stock that we featured in our stock guide, and from the beginning and answering all the questions that they might have. Of course, members can also view all the archive as well. And one of the most valuable part of VIA Club is actually our community. Now with a few hundreds members, and they are very active, especially on our Facebook group. And I feel that is the most valuable part of VIA Club. And of course, we also do live webinar similar to what we're doing right now, but maybe in a longer form for our members. Once in a while, we're actually doing one next week to review our stock guide 2020 and the top 10 stock within the stock guide, and answering some of the questions that members have, right? So these are just features of our VIA Club feature. If you want to, take a look at it and take our relationship to a next level, you can consider it. It's only $158 a year, and we have a 14-day money-back guarantee, so you can try it out for 14 days. If you don't like it, just give me a shout out. I can sort it out for you. So once again, the link is bit.ly/Club VIA if you're interested, and I'll put the link down on the show note as well here. So now let's get back to some of your questions. All right, hope you liked the short presentation that I had. I'm just scrolling back to some of your questions. Let's take it back up in the front. Abel is asking, any feedback on the latest IPO on Hong Kong Exchange like Yam China and Nofu Water? I have not looked into the Nofu Water yet. Maybe you can give me a private message and I'll try to check it out a little bit for you. Yam China, I guess, is that part of the KFC group? If that's the Yam China you're talking about, I actually like it, but of course, it is. I don't find anything that particular special with them. It's a great franchise, and just might not be exciting enough for me at the moment, right? Bing is asking, what brokerage do you use? I use a few. Of course, if you in some of my videos, you might have heard me talking about FSN1. I do use FSN1 as well. They have good access to the US, Hong Kong, and Singapore market. I also use Philip Poems, and for some of my family portfolio, I actually use Interactive Brokers as well. So if you want to check it out, they should have access to all the markets. All right, Adrian, you're talking about your first question. What are the top 3 biases you focus on and how do you practice it? When you're talking about biases, you're talking about psychology biases like overconfidence, loss aversion. That's a great question. I don't think I rank my biases, but one of the things that I try very hard to control myself is FOMO. I try not to, if some stock is rallying very high, and I guess this is human nature that we will try to feel that we have missed out on the boat, but I try to control that and always go back to the basics of finding stocks that I'm comfortable with for the long term. So some stock might be high flying at the moment, but I try to remind myself that, my stock keep me rested at night and I don't have to worry too much about that. So that's basically some of the things I look at. And also, I try not to look at stock price so much, especially in a declining market. I try not to look at stock price too much to affect my judgment. So I try to do my research regardless of what the market is doing to build up a watch list stock. And just from there, when I have some time, or when I feel that it's time to relook at how to add more stocks to my portfolio, then I'll pick a stock from that watch list. So that's sort of my flow. All right, cool. Yao is asking, what's your view on Hang Seng Tech Index? I guess you're talking about the new ETF that's recently came out for the Hang Seng Tech Index. I just have a member who was chatting with me about this yesterday. I look at them. Basically, it's a good move forward by Hang Seng, and At the moment, though, their expense ratio is a bit too high. And I guess one of it is actually quite a small cap fund at the moment. So for me, I still prefer some of the US funds with a larger size and a much lower expense ratio for the moment. But if Hang Seng is able to build this up even more, then and bring down the cost of the fund, maybe we have quite an interesting ETF here in Hong Kong as well, right? Okay, Chris is asking any thoughts on medical stock in Singapore? No, not really. I don't really have much thoughts on the medical stock in Singapore. Most of them are pretty small cap, and I try to. I guess I don't invest that much in small cap stocks because it's the business itself is more volatile, and some single factor might make or break the business. I try to look at companies that already have quite established and defensive revenue stream, so I don't really invest in that sector. Sorry. I do have Raffles Medical. Mainly I bought it because of their growth in China, but of course so far it has not been doing well, but I'm still sticking to it. But I don't find it extremely extremely unique in a sense compared to other healthcare companies. All right, Jun is asking, what's your view on SE? SE, I guess, is C Group, right? Yeah, so C Group, just now I think we mentioned a little bit about it. Their main three pillars of business is, of course, gaming, their Shopee e-commerce, and also Shopee Pay, which is, I guess, sort of linked to Shopee. The gaming business has always been profitable. You can sort of see them as a mini Tencent. They also distribute some Tencent game, not as diversified as Tencent. Individually they only have one game that they publish by themselves and is popular, Free Fire, which is a knockoff from PUBG. But they do license a few games from Tencent, and they are an investee company of Tencent. So I guess that relationship sort of would be a buffer for them on their gaming business. So it should still be doing pretty well. Shopee is still loss-making, but I hear many good things about Shopee. Personally, I'm a user, so I'm quite happy with Shopee. Hopefully, they can reach a point where it's at least a little bit self-sustainable. Right now, I think they're still far from it. So if you're betting on it right now, it's a little bit speculative, but if you size it correctly, I think it should still be okay. But without their gaming business, if it's just Shopee alone, maybe it's sort of like a GoPro kind of business. So either you make it or be prepared to lose most of it. All right, Mingli, how can you tell that the company is dying? Okay, so one of my key criteria right now when I invest in a company is it must at least be growing both its revenue and its profit. If a company cannot even grow, or its revenue is just stagnant, I see it as a dying company, right? Mainly because the value of money is decreasing every single year. And if you're holding cash, the cash is depreciating every single year. So for a company, you should at least grow in terms of inflation just to keep the value of the company, right? So if a company cannot even grow at all, is stagnating, then I would not be interested in that company. I see it over a longer period of time, right? Maybe 5 years. I look at the 10-year period. Both they could be a little bit volatile, but I should still see a general trend that the company is able to grow, and also is profitable. So if it's not, I just stay away. Yeah, easy as that. GS Tech is asking, Tesla will be the Apple of stock. Apple of stocks? I don't quite understand your comment, but I guess you are very optimistic about Tesla. Again, I think similarly to C Group, Tesla is kind of an interesting company. We actually chatted about it yesterday. So Tesla, it has been so successful mainly because of it has been growing the business, but it has been growing the business because investors has been so optimistic about stock, giving it an avenue to continuously raise more and more money and capital to fund the business. I think Tesla has reached the point where they are at least breaking even. So if they want to, I think Tesla can be profitable, and hopefully the worst is over for Tesla. It's not a stock for me right now, just on the crazy valuation. But if you feel that you need to have the stock, if you size it correctly, I think it still can be a safe bet. Okay. All right. Let's take another 2 more questions before we call it a day for lunch. My wife and daughter is waiting for me for lunch. So let's look at ABC. ABC is second. What's the ideal stock for you to hold in a portfolio for diversification? Isn't 40 stock too diversified? So in my portfolio, I own about 40 stocks. And it might be a little bit too many, but it works for me so that I don't be too dependent on any one stock. At some point in the past, when some of my stock has grew because it has just been growing, and it become maybe like 10-15% of my portfolio, there's sometimes I try to cut down and put it back to around a 5% position. So that's how I manage my portfolio in such a way that I'm never really dependent on one stock. Sometimes it hampered the growth because all these growing company, they continue to grow even after I sell them down. So in theory, if I never sell them down, it will continue to become a bigger part of my portfolio, and I should even have a bigger return. But just to err on the side of safety, if you follow all of my videos, my tagline has been invest safely. So just from a portfolio standpoint, I try to keep everything as safe as possible. And I think if for general wise, at least 15 stocks in the portfolio, that should be suffice. And you don't have to start with straight away buy 15 stocks. If you have already a plan that you're going to be investing for the long term and you want to keep a portfolio for the long term, you can start with one and then slowly add them up. But once you reach about 15 stock, that should be quite a well diversified stock if they are all have different exposure, right? Okay, final thoughts on let me have something that maybe I can answer. Okay, let's take the last question from Stanley Teo. I like your name, Stanley. A good company can turn bad for many reasons. So when you hold a good company that turned bad, how do you decide when to cut loss? Okay, very good question. I'll give you an actual example. I wouldn't say the company turned bad, but just maybe the situation changes. In the past, a few years ago, I invest in a stock in Singapore called Dairy Farm International. Right, Singapore investors should be quite familiar with it. They are a retail chain, so they own brands like Giant, Cold Storage, Guardian as well, all over Asia Pacific, right? Part of the Jardine Group. So very strong company, very strong backing, has been around for many years, good brand in the retail space, one of the biggest guys in retail space across Asia. But I owned them for, I guess, a few years. But what I see is when I monitor the landscape is changing. Companies like Shopee, Lazada, Alibaba, they're coming into the market. Right? Even Amazon came into the market. And these are companies, although they are considered a newcomer into the market, right? But they are company with huge resources and very, very strong in e-commerce. And they almost have unlimited resources to fight Dairy Farm. So even if Dairy Farm is the incumbent in the space, the whole landscape has changed, that they become the underdog in this fight. And the trend is not in their favor because trend is moving more towards e-commerce rather than offline shopping. So from that point, when I look at the how the landscape has changed, I decided to cut loss and sell off my stock in dairy farm. So this is something that I monitor. I monitor it more on a fundamental basis, like if the whole landscape has changed, if I feel the company has not been able to sustain its growth, the growth is really slowing or even declining, then I review it. But I don't really sell a stock just because the stock price has dropped, right? So in fact, many of the stock that I bought, once I bought them, you can ask my VIA Club members, because I publish all my live trades. So before I buy a stock, I tell my members first, hey, this week I'm looking to hopefully buy such and such a stock. And every time I buy, more often than not, the stock price fall after I buy. Right? So it's the indication now. There's an internal joke within my VIA Club members that when Stanley buy, we should wait for it to drop first, then they buy. So I'm not worried if a stock price drop, but I'm more worried if the fundamental change for the company. So that's how I review my stock, right? So for that's it for our webinar today. And of course, our VIA Club registration is open till Sunday today. If this is something that you are interested to read up on all the reports that we have inside, we have close to, I think, more than 50 stocks report within the VIA Club right now for members to hunt around for their next good stock. So if you're interested, please go to bit.ly/clubvia for more information. And till that, thank you for your time. Till we meet again, invest safely, guys.